In this module, we'll take a further look at the financial statements. Specifically, we'll talk about the classified balance sheet. When you're faced with a big task, it helps if you break down the task into smaller, more manageable parts. This will help you avoid stress, but it will also increase your understanding. So, we first look at the entire task. Then we break it down into smaller, more manageable, or more understandable parts. And these parts are based on similar items that get grouped together. Then we complete the required work and look back at the entire task to make sure that things work together. We'll start with the classified balance sheet. As a whole, the balance sheet illustrates the company's assets, liabilities, and owner's equity at a single point in time. The subparts for the balance sheet are also based on time. And the first thing to know is the breakdown between short-term and long-term. Short-term is up to a year in time, while long-term is more than a year. We'll go over each in a moment. Let's start with current assets. These are assets which are cash or expected to become cash within 1 year or one operating cycle, whichever is longer. The operating cycle of a company is the average time required to go from having cash to having cash again. In other words, to go from spending cash to make or buy inventory to selling that inventory and collecting the cash from the customers. Some companies use a period longer than 1 year to classify their assets and liabilities as current because their operating cycle is longer than 1 year. Examples of current assets are cash, short-term investments, which include short-term U.S. government securities, receivables, accounts receivable, note receivable, interest receivable, inventories, and prepaid expenses such as prepaid rent, prepaid supplies, insurance, and advertising. Then, on the balance sheet, current assets are listed in the order in which they're expected to be converted into cash. This is called the order of liquidity. I want to take a moment to further explain how accounts receivable affects cash and the income statement. A sale is first made on credit. You might often see the words on account, and that means the same thing as on credit. A key here is to know that the company earns sales revenue, and it will appear on the income statement, even though cash has not exchanged hands yet. At the point of the sale, the customer owes the money, and an accounts receivable is created. Receivables are generally due within 30 days, so they're a very liquid asset. And at this point, sales is on the income statement, and accounts receivable is an asset on the balance sheet. Now, when the customer pays the receivable, cash flows into the company. Notice the cash has changed hands, but nothing changed on the income statement. We recorded income when it was earned. We see cash show up on the statement of cash flows. We also see the asset accounts receivable decrease and the cash on the balance sheet increase. The next asset on a classified balance sheet is long-term investments. These are assets that can be converted into cash, but whose conversion is not expected within a year. These include investments in stocks and bonds of other corporations that are to be held for over a year. Long-term assets not currently used in the company's operations, and long-term notes receivable. Think about them this way. Management doesn't want to keep everything they have in cash since they can earn more through investments. So these items are the stocks and bonds of which you already know, but other investments can be land, buildings, etc. So if management purchases land to hold and resell, it is an investment. The next asset on a classified balance sheet is property, plant, and equipment. Assets with relatively long, useful lives. They have to have a life over 1 year to be a fixed asset. They are also assets that are currently used in operating the business. Remember, if they're not being used in the business and they're long-term, they would be investments. Sometimes these assets are called fixed assets or planned assets, and examples are land, buildings, machinery, equipment, furniture, and fixtures. Companies purchase PP&E, or property, plant, and equipment, to be used in the company. They purchase machines to manufacture inventory, computers to do the necessary calculations, trucks to make deliveries, etc. When they are purchased, they will help the company generate cash in the future. They have an economic benefit, so they're assets. However, using them also causes them to wear out. So we have to manage the purchase as well as the wear and tear on the assets that are used. Now, the assets are recorded at historical cost, and this is one of the generally accepted accounting principles. The cost of the asset is the amount paid plus any ordinary and necessary amounts expended to get an asset in condition for its intended use. The use of those assets is an expense since it is using the resource as part of the company's operations. The full purchase price is not expensed in just 1 year because the assets will be used for more than one accounting period. Instead, fixed assets are allocated over their useful lives, which is the length of time you expect the asset to be valuable. We call this allocation depreciation expense, and over the life of the asset, we depreciate the asset's depreciable base and calculate the amount by using a systematic method. I'll go over an example in a minute, but let's focus on some terms. Depreciable base is the cost minus the salvage value, or the amount you expect to sell it or trade it in at the end of its useful life. It is the amount of cost that will be depreciated over the useful life. The depreciable base is allocated over the useful life, and we call this allocation depreciation expense. Accumulated depreciation is the total amount of depreciation that has been expensed since the asset was placed in service. Accumulated depreciation is a contra asset. It is on the balance sheet, but it is contra, so the amount goes against another asset. In this case, it goes against the cost of the asset. So we can show the purchase price of the asset at its cost. But by showing accumulated depreciation, we also show that the asset is wearing out. And the cost of the asset less the accumulated depreciation is the net asset, or net book value. By the way, note that land does not wear out, so it is never depreciated. As a note on depreciation, the depreciation method is simply the pattern by which the cost is allocated to each of the periods involved in the service life. There are many methods from which to choose, and the 3 most popular methods are straight line, double declining balance, or units of production. There are various methods because things wear out differently. For example, assume a $100 asset is to be depreciated over 4 years. Under the straight line approach, depreciation expense is simply $25 a year. This is shown in blue, and it may seem very logical if the asset is used uniformly over the 4-year period. But is that what really happens? Think about your car. The decrease in value is greater over the first year and not as much in the 4th or 5th year. An accelerated method like double declining balance is shown in red. It has more depreciation in the first year, and the depreciation amount decreases each year. The final method, shown in green, is units of production. Notice how it's higher in year 4 than year 3. That is because the depreciation per unit is the same, but the depreciation total is greater in years when the usage is greater. So in this case, the usage in year 4 is higher than year 3. The last major category on the classified balance sheet is intangible assets. These are non-current assets that have no physical substance. Examples are goodwill, patents, copyrights, and trademarks, or trade names. Similar to depreciation expense, these assets have amortization expense as their usefulness wears out. Current liabilities. Similar to current assets, current liabilities are dependent on time and current obligations that are to be paid within the coming year or the operating cycle, whichever is longer. Common examples are accounts payable, wages payable, bank loans payable, interest payable, taxes payable, and current maturities of long-term obligations. Another example is notes payable. Now, within the current liabilities section, companies usually list accounts payables first, followed by notes payable. Long-term liabilities. These are obligations expected to be paid after 1 year. Liabilities in this category include bonds payable, mortgage payable, long-term notes payable, lease liabilities, and pension liabilities. Many companies report long-term debt maturing after 1 year as a single amount on the balance sheet and show the details of the debt in the notes to the financial statements. When dealing with equity, there are two parts. The ownership piece is the common stock. This is the investment of assets into the business by the stockholders. The value is typically the number of outstanding shares times the par value of the stock. Common stock is recorded at the same amount per share in this account. But the price paid for the stock is always changing, so the amount paid in excess in par is recorded in the account called additional paid-in capital. And as an FYI, preferred stock still exists, but it's losing its prominence and we won't really discuss it. The other part of owner's equity is the earnings piece. Remember, retained earnings is the income retained for use in the business. Technically, it's the amount in retained earnings at the beginning of the year, plus the year's net income, or minus the net loss, and less the amount of dividends paid. Also remember that the statement of owner's equity shows this calculation. That's it for the classified balance sheet. Please let me know if you have any questions.